The secondary type, which is in the world that we mainly play in, is called a sale-leaseback. In this transaction, we are buying the property from an owner occupant. So, imagine you have a tenant who makes, automotive, liquid fluid assembly mechanisms, right? They've been in place, they own the real estate as well, and they may be looking for effectively to pull the capital out of that dormant asset, being the building, and they do that through selling us the property and then simultaneously leasing it back.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Welcome back to another episode of Decoding Cashflow. Today, we have a very special guest, Neil Wahlgren. Neil brings over 2 decades of leadership in operations and capital markets. Prior to joining MAG Capital Partners in 2019, Neil led a Bay Area real estate investment firm facilitating the acquisition of approximately $500 million of income-producing commercial real estate. At MAG Capital Partners, while investing in industrial properties, he emphasizes on manufacturing tenants in parallel with sales-leaseback transactions, creating values through institutional lease and long-term alignment with proven tenants. He is a graduate from U.S. Air Force Academy and have served as commissioned officer and pilot in U.S. Air Force and Navy. Thank you for your service, Neil, and welcome to Decoding Cash.
Great. Thanks for having me, Ted. Glad to be here.
All right, great. So, Neil, before we get started into your niche, right? This get into more detail on industrial assets. If you can give our listeners a little bit background about yourself, let's go way back when during your I would say serving while you're serving as a pilot, and then get into how did you get started into real estate and what's your main focus at MAG Capital as of now?
Yeah, no, absolutely. Yeah, I'm a California native. I live in San Francisco now, but born and raised in the East Bay, a little town called San Ramon out here, and kind of a very structured upbringing. And I kind of wanted to really get out of that very predictable, safe community, and was looking for a little excitement. I was 18 and decided that the military might be a good route. So researched a little bit and decided aviation really called to me. So I started flying lessons at 16, and then ended up getting a commission, senatorial commission in the Air Force Academy. So spent 4 years there in Colorado, and then a pilot slot. So I ended up flying the C-130 Hercules, which is kind of it's tactical airlift. Another way to think of it is kind of last mile logistics for the cargo world. So you've got the big boys,
the big ones,
big heavy things, and then it gets smaller and smaller. And we were kind of the last delivery truck, if you will, in the across the airlift logistical network there. So propellers and two deployments to Iraq and 2 to Afghanistan, and really just a great way to kind of cut my teeth in terms of life experience and in terms of really forging a lot of meaningful relationships and getting to have a lot of relatively early opportunities for leadership and kind of operational complexity in that kind of chaotic world there. So did that for about 10 years and ended up getting my MBA through the Air Force. And then I moved back to California and hopped around a little bit on a couple startups and really decided, I kind of had this transition point where, I love the flying and I love the, day-to-day kind of excitement, but, you start, hit your 30s, mid 30s at that point, and you start looking forward going, okay, how do I see the next 10, 20, 30 years? And how is this going to position me for where I want to be? And really a big driver for me was that kind of time money trade-off that you and all your listeners are certainly familiar with, and ultimately got more and more into investing. And I really just had a strong calling from real estate. So I moved up to San Francisco, partnered up with a guy in the Silicon Valley who had kind of a firm focused really on the capital raising side, and we would partner and vet and due diligence with other operators, experienced managers, sponsors, and really do deal by deal on that side. So I did that for about 4 years. Like you mentioned, we worked with about a dozen sponsors, and one of those sponsors was actually Mad Capital Partners. So really I love the industrial model, love the partners who founded the firm there, and ultimately was able to join them full time in 2019. So since then, I've been with Mad Capital Partners and really focused on industrial net leased real estate.
Have you always been on the commercial side, or have you done the residential side before you joined Back Capital?
I've done a little residential personally, but in
Uh,
terms of the professional side of things, really always been on the commercial side. So on the previous firm, we had done retail, we had partnered with experts in development, in office, multi-tenant retail, just you name it. It was a really wide spread, which was nice to get to really kind of cut your teeth across a lot of asset classes. And I really got to see the range, right? I mean, you have, take development, you're going to have, high potential returns, but a lot of, variables that you may or may not even be able to identify before you get into it.
you got to be really experienced, manager, I would say project manager, construction manager to
Exactly.
get into that segment and
Yep.
time box everything, money wise, time wise, everything. Yeah.
Absolutely. And then on the other side of the spectrum, really more cash flow focused, investments
Mhm.
focused on yield, limiting downside risk, and, kind of providing more of that true kind of passive investment, reliable income generating asset. And that's really kind of more where the industrial assets fall on that side of the spectrum. And that really kind of called to me personally and really, drew me in professionally on that side.
Like, did you dive into real estate while you were serving a U.S. military, or
Yeah,
after that?
I bought a couple of turnkey investment homes, just residential,
Mhm.
and then I
Right.
didn't start into the commercial investing side until I got fully into it professionally there.
Professional. Okay. So now at Mag Partners, you said you guys mainly deal into industrial assets. Uh, what different kinds of, if you can give a list of what different kind of industrial assets there are, and in within that those segment, those different assets, which is the specific segment you deal with? Because
Yeah,
there's big storage units, industrial flex space, many different. So if you can just give a
absolutely.
little, yeah.
Yeah, to kind of provide the listeners with a little high
Mhm.
level
Yep.
view of the industrial market. I mean, really, you have on one side what a lot of people immediately think of as industrial means smokestacks and gravel yards and really heavy
Yeah.
industrial. Think even an oil refinery would be about the heaviest, dirtiest industrial there. We don't play in that world. We play in the second segment, which is going to be light manufacturing, and that's going to be typically what we call, I mean, more or less square boxes, largely in secondary or what I call commutable primary. So you're not going to find these downtown. You're going to find them a little more on the outskirts. Visually, they're going to be, more or less four walls and a roof, and provide a space for a mix of warehousing, distribution, and manufacturing. And then if you go down the road, there's also specialty industrial, and that's going to be really high dollar per square foot, typically tenant specific build outs. A common one is life sciences or biotech, temperature controlled, climate controlled, very, clean rooms. Those are going to be very specific to one particular industry. And then the last major category of industrial, like you mentioned before, is going to be flex industrial. And that's going to be more similar to multi-tenant retail, where you'll usually have very long buildings subdivided into, 500 to 3,000 square foot spaces, and each of those will be, a range of different uses. So that last category tends to be a little more property management heavy.
Hmm. So, as you mentioned, you mainly deal with the manufacturing segment, right?
Absolutely, yeah. So I would say that the vast majority of what we buy is going to have a single tenant. These
Okay.
tenants are typically, a company that's been around, 50, 60, 70 years. On average, they do 80 to $100 million or more in top line revenue. So really established firms, they fully occupy the space. And then we come and we will set them up with long-term absolute net leases. So really the name of the game on these investments is buy an asset with a good basis, securitize your revenue through a long-term net lease that protects you from expense surprises. And then the risk is really who's on the other side of that lease. And that's going to be more or less what is the tenant of that credit who's in place in your building. So we have a really strong underwriting team who comes through and they will do 3 to 4 months of due diligence, looking at the credit of the tenant, really making the bet. A, do we think they're going to stay in business during the time we plan to hold this real estate? And B, will they pay rent on time? So that ultimately is the financial risk that we're looking to control on these investments.
Mm-hmm. And what is the acquisition process actually for these kind of investments? Because you don't see them online or any quite often. These kind of what are your main source of leads?
Yeah, no, great question. Really, there's two more or less categories of transactions. One is going to be what I call a stabilized sale, purchase and sale. Typically, that will be an in-place tenant, an in-place lease. You have a seller, a third-party seller who owns the property, and a third-party buyer buying it. That new buyer will assume the lease. Usually, the tenant stays in place, and it's simply a transfer of hands. The secondary type, which is in the world that we mainly play in, is called a sale-leaseback. In this transaction, we are buying the property from an owner-occupant. So, imagine you have a tenant who makes, automotive, liquid fluid assembly mechanisms, right? They've been in place. They own the real estate as well. And they may be looking for effectively to pull the capital out of that dormant asset, being the building. And they do that through selling us the property and then simultaneously leasing it back. So inside the operations, there's no change, right? Every day workers come in. Most of the time, they don't even realize this has happened. But just on paper, they are effectively exchanging ownership of the building for an influx of capital and then signing a triple net lease in exchange. That's really where we come in. And then to answer your second question, where does the deal flow come from? We have really, there's a special subset of brokers called Sale-Leaseback advisors, and they will come and coach companies who own their real estate, kind of what the advantages of this mechanism is and why it's good for them. And then often these companies are being acquired by outside private equity firms. And when those private equity firms purchase new companies, often if they own the real estate, they prefer to sell the real estate and take a tenant position. So we get a lot of deal flow straight from private equity sponsors as well.
Mm-hmm. So they sell the real estate, take the money, invest in the business process, just to expand their business, right? That's what they're not in the game to hold the real estate, or they're not in the game for cash flow.
Exactly. And a common question we get is why would a company sell an asset that they have and become a renter, right? And really, from a high level, the business believes they can generate a higher internal rate of return than they can own in real estate. So, a real estate investor might expect say a 14 to 15% IRR on that real estate investment for that risk profile, whereas a company may say, hey, we think internally we can produce 25, 30% IRR. So by moving that capital over to the operations side, they often believe they can generate more growth capital and more profits with the money moved into operations there.
Yeah. And with the being a single tenant property, right? Isn't there a risk associated with it? Because what if that they go out of business? What will be the backup plan for that?
Yeah, no, it's a great question. When you're buying or investing in single assets, so one particular property with one tenant, the risk profile is significantly more binary to that effect. You are either fully leased or your tenant is in default and you have no revenue
Yeah.
coming in. So it's important to understand there's a lot of stages between, a missed rent payment and a full default empty building. But ultimately, we come in, we look at, hey, what's the true, financial strength, securitization, their EBITDA, their debt load, what are their other obligations? In the event even that they have to go Chapter 11, Chapter 11 means reorganization. So often the lease is kept intact. Meanwhile, the internal debt and equity structure of that company is just simply getting rebalanced. In the event of a Chapter 7 liquidation, that would be what we call dark value. So then you look at, okay, if I didn't have a tenant in this building, what's it worth? And we always make sure that we come in at an acquisition basis, roughly at dark values. That means, even if we lost a tenant, worst case, we could either release it or look to sell it at roughly what we put into it. So that's ultimately, kind of how we manage that. And then about 3 years ago, we introduced a fund model. So now, effectively, the fund is the investment vehicle, and the fund will own 15 to 20 different industrial net leased properties. So even if you did have a worst case scenario in one of those, you still have cash flow, you still have, the ability to cover overall debt service in a much more diversified vehicle there.
Okay. Yeah. So you diversified via fund. So that's a good thing. So not every, the effect is not that much if one of the asset under the fund is not performing as expected.
Exactly. Yeah.
So yeah.
I will add, and sometimes it's helpful to go, how often does this happen, right? So in our experience over 10 years, we've had about 142 tenants and only one default. And even in that default, we're able to fully return capital plus a double-digit return to investors. So it's really, if you do your analysis up front, it's a very, very rare event on that side.
Mm-hmm. And I assume these might all be triple net leases, right?
They're for those not familiar with the triple net, that means our tenants are paying all their utilities, they're paying all their property tax, they're paying all insurance, to include environmental insurance that we dictate. And lastly, they're going to cover building maintenance. On these type of properties, that includes, new roofs, bathroom repairs, HVAC, and it actually fence line to fence line. We're talking pavement, landscaping, you name it. Everything about the land and that property is fully paid for and maintained by the tenant.
Yeah. All right. And like return, if you talk about the return of investments, right, compared to the other asset types, let's say multifamilies or maybe flex spaces or storage units, how would you compare the return on investment on these industrial, especially this manufacturing related assets?
Yeah, no, it's a great question. I would say the structure of industrial between the net lease being much more predictable income in that you're not affected by expenses. And then also the debt that we pair with it. We're always going to, if we put debt on the properties, it's going to be long-term fixed rate debt. So we know exactly what the revenue is. It's the rent. There's no expenses. And then we know exactly what we owe for a mortgage every month. So it becomes a very predictable income stream. Every year, that lease is going to have annual increases in that rent. So we know every year our rent profile is going up. Every year, the principal owed on that debt is being paid off. So it's a very, I would say, much more predictable equity stream in terms of overall return. So we tend to be higher on the cash flow during the hold period. And then in terms of overall returns, I would say we're probably somewhere near the middle of the different asset classes, where we, typically will project around a 15 to 17% IRR on our projects. I think we've delivered close to about a 19% overall on full cycle investments that we've had.
What are the size of your projects normally?
They range.
Is there any minimum or max amount that you invest per project? Like per asset, I would say.
Per asset, I would say most of the properties on the low side will be about 6 or 7 million. On the high side, about 30. Most fall right around 15 to 20. And then, On the funds, we'll package, I think our last fund, we packaged a little over 200 million of industrial real estate. This third fund that we've just kicked off is targeting close to about a $500 million of real estate in there.
Mm-hmm. And how do you select these, or maybe how do you scan these properties? Like any specific things that you consider to filter out, this is the right property, this is not, anything
Yeah.
specific?
It's interesting with the net lease compared to other real estate asset classes, the specifics of the actual building are much less important on a relative basis.
Mm-hmm.
We do send in full building inspectors up front because even though the tenant is responsible for maintaining and repairing any deferred maintenance, you have a lot more leverage identifying that before you buy, right? So you can go, hey, the roof needs repair, you got leaky, the HVAC is broke here. Fix this before we close on the purchase here. So at least we know from day one we're getting a fully maintained property there. But beyond that, I mean, really, I would say that the credit of your tenant is much more important. The quality of that lease is substantially more important as well. And then, ultimately, we want to make sure we're buying a good basis real estate, B, that it's at a fully maintained condition when we buy it. And then ultimately beyond that, we'll send in inspectors about every 2 years, just making sure that the tenant is following the obligations per their net lease there.
Yeah. So most of these would be sale-leaseback acquisitions, right?
Correct.
As you mentioned, it's no direct acquisitions where
Every
you
once in a
buy.
while we will.
Yeah.
I wouldn't rule it out, but I would say
Uh-huh.
predominantly we're able to produce a little additional alpha in our investment profile through that sale-leaseback side, just because it is a more complex acquisition that fewer people are able to accomplish.
Yeah. And talking about that, right? You mentioned there's a less competition given the complexity of these transactions. Do you see a competition similar to the other industrial spaces, or in the
Yeah, no,
sales leaseback, or
it's a great
it's very
question.
specific small group of people who are always bidding for the same property?
Yeah, I mean, we always joke there's probably 30 industrial real estate brokers who do, 80 to 90% of the business nationwide. Our competitors typically are much larger REITs. We'll play battle against, big publicly traded REITs who play in this space. Firms that have really built up, massive, credit shops, this and that. They tend to be more like a cargo ship, a little, tighter buy box, a little more narrow, whereas we can navigate and be a little more nimble and creative in terms of how we structure the acquisitions. But I would say most of the firms we compete with are 10 to 15x size.
Mm-hmm. And if someone wants to start looking into these kind of assets, start sourcing the lead, where should they start? Like, whom should they contact? How should they proceed focusing on getting these kind of leads?
Yeah, I mean, most national and local brokerage shops, if you remove the sale-leaseback acquisition channel and more look at established industrial with a net lease in place, those, I mean, most national and regional commercial real estate brokerage shops will have an industrial player in there, right? Especially closer to bigger cities. And that's a great place to start, and at least you can kind of narrow it down a little bit if you're looking to invest and acquire individually. You can look at your different regions, find out what the triple net price per foot average is on the rent side. Look at, hey, what's the prevailing cap rates out here, because it really does change quite a bit. And then, I mean, you just need to lean heavily on an expert who's done it a long time. So for most, I'd say, especially with industrial, because most people don't get started on their own there. It's much more advisable to, kind of begin investing with someone who's been in that space a while, learn the ropes, learn what to look for and what to avoid. And then, over time, some folks will graduate and, start buying and selling some of their own.
Yeah. Yeah, no, that's what I also say. Like, the industrial space, it's a kind of a niche where you need to have an experience either through partnering with someone, you cannot directly jump into the industrial space without any experience. So, of course.
I firmly believe that. I
Yeah.
always joke, right? Because everyone's been in a retail store. Almost
Mhm.
everyone has either lived in an apartment building or, visited one. Almost everyone's been in some sort of office before, but many folks have frankly never been in an industrial warehouse, I
Yeah.
mean, maybe outside of Costco, but that's,
Yeah.
a little more retail. But there's just not a lot of reason for, your average citizen to spend time in an industrial manufacturing environment, right? So
Yeah.
that makes it a little bit more of a foreign investment asset. I firmly believe it's one of the best, most compelling assets out there, but it definitely requires a little bit extra, education and or investing with someone who's done it before than some of the other commercial real estate classes out there.
And do you do any value adds on these properties, or you just lease it back and that's it? You let it run as long as
Yeah,
you
we
can.
we actually do some level of value add, probably on about a third of what we buy, and that's going to be typically one of two ways. One will be contractual. Typically, if we buy an in-place lease that we feel like there's a lot of meat on the bone, but say it's short or maybe has really choppy, lease jumps. We've seen some where, the rent is flat for 5 years and then it'll jump 25% or whatever it might look like. And we can actually negotiate with the seller who often becomes our tenant and go, hey, let's smooth this out, right? Let's create a steady escalating income stream. We might move your base rent, but end up where we want to be, and really renegotiate it to a win-win where it's more sellable on the back end, and it's a more of a predictable income stream for both parties. And then the other value add that we do, we actually have a full development team in-house. And this is typically after we buy the asset. Oftentimes, a year or two in, the company, especially if they just got a new private equity backer, they're growing the firm, right? They might say, hey, we need more space. We're looking for additional real estate. And we might say, hey, you can do that, or we can build out an expansion on your existing building here. So often it'll sit on excess land, especially in secondary metros. And we'll come in, and we've had projects where we build an additional 20,000 to 100,000 square feet addition on the existing land. And what's nice is you can pre-negotiate it, exactly where your cost structure will be, and you know exactly what that new increased rent will be when you're finished. So you can
Yeah.
kind of blend in a much higher cap rate into what might have been a more conservative acquisition and end up with a great kind of value add blended cap rate there.
So in short, what it means is like if the business is growing, they need more manufacturing space, and you have the land available, they'll ask you to build a separate complex or a separate, or extend the current facility.
Exactly. Yeah. Yeah,
Yeah.
it can look a lot of different ways, but we actually come in when we buy the properties, we will kind of position ourselves as a full service landlord. So say, hey, we want to be your partners in this. We're not just collecting a rent check every month. Instead, we want to be, kind of your full service partner here as your needs, grow and increase. We can be your development piece to make sure the real estate continues to meet their needs there.
So when these private equities come to you to sell the real estate, right, and keep the business, how does it work? Like they give you the price, like, okay, we plan to sell this property for $6 million, and this is the rent we're going to pay. How does it work? The rent versus the price. How?
Yeah, it's really a very nuanced transaction, right? So
Mhm.
consider, let's say you have a fixed cap rate, right? We'll take an 8 cap.
Mhm.
In that scenario, you could say, all right, what do you want to maximize for? Does the seller want to maximize to get the most amount of money for that building? Or do they want to maximize and have a very, below market rent for the next 15 years, right?
Mhm.
So if they want to maximize proceeds, we might say, okay, we can do this on the upper end of the market, but we're also going to lease it back at a relatively high rent. Or they might go, no, we want low rent. So we're going to go, okay, we're going to pay a lower price and lease it back to you at a lower rent. In both of those scenarios, you can still equate to an 8 cap, but you're able to have a lot of nuance in there.
Mhm.
Or you could extend the lease longer, which is better for us, or they might want to shorten the lease, which is usually better for them. a number of different variables to end up where you want to be. So a much more nuanced transaction than simply coming in and agreeing on a price there.
Yeah. So basically, like I would say, the most important thing is the cap rate that you keep in mind, and based around the cap rate, you negotiate the buy price or the rent accordingly. Yeah.
Absolutely. Yeah. And one really important piece that's tied to that cap rate as well is going to be the quality of your tenant. So
Mhm.
that's ultimately your risk, right? And it's
That's right.
important to remember at some degree, a cap rate is a reflection of risk. So a lower cap
Mhm.
rate is going to apply a lower risk for an investor and generate a lower return, whereas a higher cap rate is the implication of a higher amount of risk and a higher potential return. So if you have a smaller tenant, or maybe, they've only been around a year or two, or they're not generating a lot of profit, that should generate a higher inbound cap rate for a buyer. Whereas, let's say you have Home Depot as your tenant, right? That's going to be very stable, very secure, and that would drive a lower cap rate there. So it's really a lot of variables that come in, but once you see enough of these, you start to find where the market is driving.
Right. Now, going back to the capital raising, right? What are your main strategies to raise the capital from the investor for these properties? Is it through syndication? I know you mentioned funds. What are the other? Can you expand on it, please?
Yeah, no, absolutely. In the early days of Mad Capital, we were strictly syndication, kind of the friends and
Mhm.
family circles, and then over time we've developed a number of capital channels to include, high net worth, ultra high net worth. We have family
Mhm.
offices that invest with us, as well as wealth advisors and RIAs. So, a number of different channels there. Really all kind of looking typically to add some industrial across the real estate profile. And we tend to fit in that high cash flow, relatively limited downside basis, and ultimately kind of that lower risk with cash flow piece of the, overall investment profile there.
Mhm. And the front, as you mentioned, you have the fund structure as of now, so you don't do syndication. It's just the fund model that you use.
We do a handful of standalone syndications.
Mhm.
Typically, if it's not strictly industrial net lease, for example, we did an office absolute net lease sale-leaseback of a corporate headquarters just about a month and a half ago. So that was the funds are strictly for our industrial assets, and then if it deviates from that, we'll often have a standalone just to keep the funds fairly consistent on what goes in those.
Mhm. And do you also do like a fund of a fund model? Do you support that also, or you don't?
We have a lot of our investments come from fund to fund. So you'll
Okay.
have, kind of a downstream fund to fund manager. They are, aggregating capital from a number of investors, and they say, hey, we want to diversify and put some of this aggregated capital
Mhm.
into the industrial sector.
Okay. All right. Sounds great. All right. Hey, like during your real estate journey, right? I'm sure you might have encountered some toughest thing during your journey. So can you tell us just one thing? Well, what is the toughest thing that you came across, and how did you overcome that?
I mean, for me, it was probably when we had that first tenant default. It
Okay.
was kind of a black swan event. They had great financials, and they ended up having an accident that was attributed to a part that they made, aviation accident actually, and they got sued by a very large customer of theirs, and it ended up forcing them
Mm.
into a default scenario. And so this is the first time we had dealt with this, in our firm's history, and kind of the stress and oh my gosh, a little bit of the unknown. And we paused, and we took about a day, 2 days, 3 days to kind of digest all the information we could, set up a game plan there. And then we called every single investor in the deal individually, just said, hey, here's what
Mhm.
happened. Here's what we're looking at. Here's a set of possible action trajectories that we can do. And I was expecting the worst. And really, it was so nice to hear, from our investment partners, just like, hey, thank you for communicating. Thank you for keeping us in the loop. We trust you as a manager. That's why we invested with you. And then we were able to kind of work through the pieces. And we ended up selling that property empty, but still for a profit compared to what we bought it for. So it was nice. We were able to fully return capital, a modest profit on top of that, and then ultimately allow them to, redeploy that into other deals. So that was definitely the most challenging piece, going into that and then working through it.
Yeah, yeah. All right, Neil, loving this conversation, but would like to be mindful of your time also. So we'll want to jump to the final round of questions.
Okay,
are you ready?
Let's do it.
Yeah. Okay. All right. So which is the one book that you recommend which had the most impact on your life or on your business?
Yeah, I read a lot of different kind of books, but recently a book called Why We Sleep by Matthew Walker really resonated with me. And
Why We Sleep.
Why We Sleep. It drove me to really look at, the time I spent in bed of all things as one of the main factors that drives success when you're awake and success at work, and really changed some of my sleeping habits in a way that I've really, been happy to see, how that has reflected my other aspects of life, both relationships and professionalism and all that. So especially we spend a third of our life in bed or, more or less, that number, it's definitely worth at least having an understanding of what's going on and how we can optimize that.
That's great. Okay. What are your main source of information to learn and grow?
I read a lot of online, like 5-minute read email newsletters because I enjoy them. They're niche. I have everything from, my favorite right now is probably The Hustle. There's that one, they bunch of entrepreneurial outlets, and they'll look at some just kind of some token, business minded articles, but kind of deep dive into, what it means and what it might, how it might affect different parts of the economy. But I love just the little 5-minute snippets of a deep dive and then kind of a niche topic area there.
Right. And what is the best investment or business advice you like to give to our listeners?
Partner. You cannot do it alone. Many have tried
with someone who has experience. Yeah.
Yeah, no, 100%. And, you don't need to be partnered forever, but cut your teeth with someone. You don't need to take all the profit on your first couple deals. Share the profit, share the experience, build up a foundation. And once you have that, then start to become a little more independent across whatever channel you want to be in.
And it's more like a team sport, right?
100%.
Regardless, if you want to grow, you have to work as a team. That's what it is. Yeah.
Mm-hmm. Especially with complex transactions like real estate.
Yeah. Mm-hmm. All right. Final question, Neil. How can Decoding Cashflow listeners get in touch with you?
Yeah, no, I'm happy to chat and follow up on anything we talked about. You can email me direct, Neil, Neil, at magcp.com. That's MAGCP. Or just visit our website. A lot of easy ways to get in touch at magcp.com.
All right, Neil, it's a pleasure having you on the show. I'm sure our listeners got so many valuable insights from this conversation. Thanks a lot for joining.
Wonderful. Thanks for having me, Ted. Take care.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.